At the beginning of the year, it looks like you called for 3.25% on the 10-year yield. We've gotten pretty close to it in the last couple of weeks.
Yes, a couple of people laughed me out the door when I came up with that forecast to begin with, but this is where we're sitting. I think what we're seeing is that impact of higher yields beginning to knock onto the equity market. For the course of this economic cycle, it has been dominated and supported by there is no alternative trade. Everybody piling into equities because you couldn't find anything in bonds. Now that the US 10 years up to 3.2%, you're starting to see investors going for the first time in nearly a decade. Hang on a second, I'm getting a pretty good risk-adjusted return in bonds. Out of equities, they're coming back into fixed income, putting a bit of defense into their portfolio.
Jeff, a lot of things for investors to watch right now. You got trade tensions, you got the Fed and interest rates, you got the peak earnings concerns. Crude oil and bear market now, you got slowing global growth, we've got geopolitical risks, we got political turmoil potentially here in the U.S. What is the big thing that you're focusing on right now?
Well, gosh, that's quite a laundry list. I think the biggest one out of the list that you mentioned is slowing global growth. It's behind everything else. Look, we've probably already seen the peak in global economic and earnings growth earlier this year. For the cycle, remember in 2019, all major economies are expected to slow, and China's the only country expected to implement any stimulus next year. Everybody else, all the other central banks, are going to be hiking rates, tightening policy, and that means it's not a question of whether there's a slowdown, but how fast that slowdown comes into place. And that's why it is a good time to be thinking about fixed income, thinking about treasuries, and maybe replacing some of the more volatile aspects of your portfolio, like maybe the emerging market sector, or even trimming tech stocks, considering more defensive areas like healthcare.
Alex, that said, SAP announces this monster deal hours ago to buy Qualtrics for $8 billion. It's in the neighborhood of 20 times revenue. This is a company that was going to go public this week on the NASDAQ, yanked back from that. That says something positive, it would seem, about M&A, about the company's appetite for growth, especially after IBM Red Hat. So why aren't we seeing that effect too?
Well, I think when investors are looking at those sort of deals, whether it's M&A and IPO'd figures, they are big green lights about where we are in this economic cycle. This is classic late cycle textbook plays where you start to see the M&A activity coming in, you start to see IPO coming in. And investors read that and being forward-looking beasts are a little bit nervous about where we are in the cycle. I think going back to what that means from an asset allocation point of view, we've been saying to investors, whilst we are still cautiously optimistic on the outlook going forward, we're encouraging people to start maybe bubble wrapping their portfolios. That's the way that I think of it, moving out of some of the growth names into some of the value names.
Even though IBM and SAP clearly aren't doing that, they're trying to invest in growth.
Well, and that would be an exact late cycle indicator, which to me is an early warning sign about where we are in this cycle. And that's why, going back to my common theme, cautiously optimistic, but not getting too ahead of our skis at this stage in the economic cycle.
Hey Jeff, are we gonna, if we're really in a period now where it's peak margin and corporations are going to have to start tightening belts into 19, are we going to start rewarding firms that, I don't know, announce more store closures or layoffs or productivity initiatives in the next quarter or two?
You know, I think if it looks like they're actually going to be effective at defending margins, then perhaps. I mean, we're getting into an environment where I think defense may be increasingly rewarded. That said, there are areas where there is some business spending taking place. Mentioned a couple of names in the business-oriented side of the tech space, which aren't sharing super high valuations and are still seeing some growth in an area that's been underbuilt over the last 10 years or so. So there are some opportunities where they're growth is still the emphasis, but for the most part, investors might still be looking more favorably on defense.